Hey, and welcome back to another SCAG Academy video lesson. In today's video, guys, we're going to go over the three laws. Now, this is going to be a super quick lesson. There's not much depth to go into about defining these and really like what they are. We're going to go into a lot of case studies in the future using the terminology of the three laws and kind of just understanding that these three things are literally law is the whole point of this lesson, right? The entire logic is based off of this. If one of them is missing or lacking, then our trade ideas are no longer valid and we have to kind of reassess. So let's go over the three laws. Again, super important just to kind of know what they are because we're going to be referencing them a lot in the future. That's what this whole first section is, right? So the three laws, again, these are the foundational core beliefs. You must accept these in order to be able to fully understand the complete logic going forward. Again, these are non-negotiable. Any deviation from these laws will more than likely result in a mistake in your trading, right? Anytime I deviate away from one of these, I think, we got 2 out of the 3. We're looking good. You're going to make mistakes. You're going to stumble. Even if there's small losses, this and that, they could have been avoided, right? So let's just really quick say what the three laws are. They're going to be the law of supply and demand, the law of cause and effect, and the law of effort. Some of these you're already familiar with, kind of, especially this first one. We have a whole lesson on just the basics of supply and demand. So we'll quickly go over that. All right, so as we know from that earlier supply and demand basics lesson, when demand is greater than supply, prices rise, and when demand is less than supply, prices fall. Right? It's our job as the trader to learn the relationship between price and volume bars over a period of time to get an accurate reading of which side is in control. Right? So again, the law of supply and demand, one of those core principles that we must kind of accept as fact. And I don't think there's any dispute about that in global markets, right? So the law of cause and effect. This dictates actually how far a trend, which is the effects, can be expected to play out based on that original trading range, right? The cause, right? So how long that trading range is. If you go back to the lesson before this about the 4 market phases, cycles, you'll actually see again on that basic price cycle those cause and effect tags, right? The cause being the accumulation, the effect being the markup. Right, so the longer you have in a cause, right, the longer an accumulation gets dragged out, the farther we can expect that effect to go, right? Because it's built up this big cause, we can expect the effect to be just as big. If an accumulation only lasts a few minutes, a few hours, if it's a lower time frame, we'd expect less of an effect from that cause. So we're going to go over specific ways to actually measure this. So this may sound a little bit harder than it's actually going to be on the chart, but the main thing to take away from this is the longer something ranges, the longer something builds up, the further that move is going to be, and we have very specific ways to measure that. Just a quick little disclaimer, in core Wyckoff logic, he uses something called a point and figure chart to come to these estimations. This is something that I've personally adapted away from. If you want to go the true Wyckoff way, I suggest looking into point and figure. But point and figure charts can be rare to come by. I think they're also just way more complicated than it needs to be in this day and age. So just small disclaimer there. Right, and then lastly, we have the law of effort. So this is when measured against results, right? So effort versus results. This will act as a few things. First, it will act as an early warning for heading into a trading range. So in a trending market environment, if we see effort versus results start shifting, then we can expect to, for prices to kind of consolidate. And then also using that, we can also expect when it's going to leave a trading range by watching for divergences between volume and price bars. A break of structure, for example, without a large effort from market participants can signal that prices may not hold. And we're going to explore all the different ways that the law of effort actually shows itself on the chart within the case studies. But what you need to understand here, the very basic, right, is the law of effort is that volume to price action divergence that we talk about, right? Big candlesticks with low volume, right? That's a divergence. Price move very far on very little effort. When you see this, you have to ask yourself, okay, what's really happening? And we're going to go over all sorts of case studies with that. But I just wanted you guys to familiarize yourself with these terms because I will be saying things like we see the law of effort in play as I'm explaining the differences between divergence and price, volume and price. So going forward, these are some of the laws that you're absolutely going to have to know, study, and abide by. And in the future lessons, we will go over exactly how we use these and put them all together. All right, so with that being said, guys, we will see you in the next video.